Growth stocks are getting slammed again in 2022, with shares of disruptive companies like Shopify down 35% and Zoom plunging 60% over the last year. These are companies changing the world, and any one holds the potential to 10x your money. But the pain is expected to continue throughout this year, so you need to know how to find these best stocks. In this video, I'll show you exactly how to find the growth stocks to buy in 2022 with a simple stock screener to start your list and how to narrow it down. I'll then reveal the 5 growth stocks to buy now, one with a 75% return just to the average analyst target. Before we get started, I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, as painful as the sell-off in growth stocks has been, you cannot ignore this side of the market. Amazon investors lost 94% of their money following the bursting of the internet bubble to $6.70 a share. But those shares are now worth more than 500 times that amount, an annual return of 36% for 20 years. Some of these growth stocks are no less transformative and will allow you to do the same thing in the next 20 years. But with those interest rates expected to go higher, you need a strategy for finding the best growth stocks to buy because there will be a huge difference in returns. In fact, David Kostin, Chief Equity Strategist at Goldman Sachs, calls the difference the single greatest mispricing in US stocks. Now, whenever someone says the word mispricing, what I hear them say is actually opportunity, and I think this is the #1 piece of advice for separating out those growth stocks to buy in 2022. Now, Kostin defines that mispricing as the difference between companies with high expected revenue, so growth stocks, but those with low or negative margins versus those with positive margins. And now there is some investing jargon in there that we need to unpack, but it's going to show you exactly what to look for in finding these growth stocks before we get into that list of stocks to buy. The growth stocks are just companies growing their sales or their total revenue by double digits each year, usually at least 20 or 30% sales growth year over year. Margins are a measure of profitability. Here we'll be talking about the net margin, which is the net income or a company's earnings divided by its sales. How much of the company's revenue is management able to turn into profits? So then the difference here, that historic mispricing and the key to finding growth stocks to buy is going to be looking for companies that are not only growing their sales at that growth rate pace, but also already profitable. The growth stocks already making investors money versus the ones that are still trading on a hope and a dream. I want to get into that list of best growth stocks to buy though, so let's get started, and later I'm going to show you how to find those quality, profitable companies and how to narrow your list to only the best. We're going to be using fundamental analysis to find our growth stocks, but another way I like to look for stocks is through technical analysis, looking for the trends and the buy signals in stocks. It's exactly the kind of strategy I put together with Thomas Carvo in a workshop on stock trading and technical analysis. 35 videos and more than 4 hours of instruction on stock signals you need to know. You'll learn everything from trading timeframes to using stock charts and finding those trends that send a stock higher. You'll be able to download a trade journal template along with trade cheat sheets and lots of other bonus material. We just launched the workshop a couple of months ago and are offering a special 35% discount, more than $150 off to everyone out there in the community. So check out the link I'll leave in the description below. I'm starting here with a stock that is already revolutionizing e-commerce, taking market share away from Amazon, Shopify Inc., ticker SHOP. And here I gotta admit, I was skeptical that Shopify could even compete against the Amazon giant, but it's created a brand for itself and a niche in helping people launch their business through the site. And the results have been amazing. 56% revenue growth over the last 3 years and 44% in the trailing 12 months. Now that's still just 1% the size of Amazon in revenue, so years of growth left, and the margin numbers here are just unbelievable. Not only has the company been profitable since last year, but it increased its net margin to 81%, which is pretty much unheard of at that level of profitability. The sales are expected to rise another 32% this year to $6.1 billion, and while earnings growth is expected to slow, it's still forecast to grow by 18% annually over the next 2 years, which is going to continue that growth stock theme. Among the 22 analysts here, we have an average price target of just over $1,600 a share, which would be a 42% higher from here. But like all of these growth stocks, I think that long-term return over the years could be on the order of 5 and 10 times that. And next here, you don't normally think of Advanced Micro Devices, ticker AMD, as a growth stock, but it has definitely put up the numbers lately. The CPU semiconductor maker saw revenue jump on laptop sales during the pandemic, and while those are looking to cool over the next year, its data center business is still producing strong growth, and this new line of Ryzen chips continues to take market share from Intel. Sales growth accelerated into the last year at a 52% rate from what was already a pretty fast pace before, and the net margin increased to 26.7% in the trailing 12 months. With the backlog in semiconductors, AMD could still book solid sales growth for years to come. In fact, analysts expect the company to post 19% sales growth this year, and I'd actually expect that to be closer to 20 or 21% growth. And earnings are expected to rise by 26.5% to $3.34 a share. Now, that faster growth rate in earnings means analysts expect AMD to continue to improve on its net margin profitability throughout the year. Now, the average analyst target only has AMD up 4% from here, but this is one of the cheapest stocks on our growth stock list. Shares trade for just 11 times on that price to sales basis, half the average multiple of the 5 stocks we'll highlight, and I think this one could go much higher than that average target. Now, all you out there in the nation know, I'm not about just dropping 5 stock picks in your lap and telling you what to buy. That does nothing for you, and I don't want you to be dependent on any old Yahoo on YouTube for your investments, even if they do rock a bow tie. So I want to take you through how I found these growth stocks, how to screen for the best to buy, and how to narrow your list. I'll be using the stock screener on Morningstar here, but I'll explain it so you can use the screener on whichever platform you use. The whole point of growth stocks is the fast sales growth. So first you want to start by screening for companies growing their sales or total revenue by at least 20 or 30% a year. You can play around with how much you screen for on these, but that's the classic definition of a growth stock, around that 20 or 30% annual growth in revenue. And you can see here, just limiting those to companies with more than 15% annual growth already puts us in the top quartile, the best 25% of companies in the market. So we're starting out on the right foot here. But that still leaves us with over 3,000 stocks, and we want to narrow our list of those growth stocks that are also profitable. So here, we're also going to screen for stocks with positive net income. That's positive earnings or profits per share. Now remember, net income is the earnings, what's left over of sales after paying everything including taxes and interest. So this is where we'll find those profits. So we'll just set this for the net income over the last 12 months to be greater than 0 or a positive net income. And that's going to narrow our list quite a bit, but it's still way too many to research. So let's go one step further. And let's screen for growth stocks that are not only already profitable, but also getting more profitable as they go. So here we're talking about that net margin, that net income divided by sales as a measure of profitability. And we're looking for growth companies that are increasing in that measure. So what we'll look for here is the net margin over the last 12 months that is higher than where it was over the last year, that improving profitability from the last year to current. Here we're down to less than 1,000 companies, but since we're talking growth stocks and the companies changing the world, I'm going to focus here just those in the technology sector, those fast-growing tech stocks. Obviously, there are growth stocks in any other sector, but for the sake of narrowing our list, we're just going to look at tech stocks for now. So here we can just screen in the stock sector and select only those in technology. And finally, that leaves us with a much more manageable list of 70 growth stocks to watch, and we can sort these by size to start. Zoom Video Communications, ticker ZM, didn't invent video conferencing, but it has definitely taken the lead in that area and has become the norm. In fact, we're already seeing Zoom do for video conferencing what Xerox did for printing back decades ago. Xerox built such a brand for itself that you didn't say anymore, make me a copy, you'd say, make me a Xerox of this. The same thing is happening with Zoom, and I think that service becomes universal over the next decade. By now we've found out that business travel isn't returning to that pre-pandemic level, and while Zoom only booked $3.9 billion in revenue over the last year, I think everyone is underestimating what this can become. This is a lot like Facebook before it learned how to make money. I remember the Facebook IPO that bombed in 2012, falling from $38 a share to $18 in just a few months because the platform didn't know how to make money off all those free users. But when that happened, the shares have jumped 18-fold over the last decade. I think Zoom is a lot like that, with the vast majority of its users on that free plan. As soon as the company learns how to monetize this, then we could see revenue jump even more than the 47% it posted over the last year. Sales growth is expected to slow to 17% over the next year, but I think that forecast is on the current strategies. If the company can learn how to monetize those free users, I think you see a number much higher than this. Here though, it is interesting that analysts expect earnings to actually fall over the next year, even on that sales growth to $4.6 billion. But given the fact that Zoom has so easily beaten earnings expectations in the past by an order of 20 or 30%, I think you're going to see earnings much higher than this. And despite that weak earnings picture expected, analysts still have a 62% upside just to the average price target, and the shares are relatively cheap here at 14 times on that price to sales basis. The stock has sold off quite a bit from last year and is one of my favorite long-term growth picks. Coinbase, ticker COIN, is one that we've talked about on the channel before, and another where I think the revenue generation is just getting started. Now, right now, Coinbase is still booking most of its money on those fees from crypto users, but the real growth here is going to come from expanding out from crypto into NFTs and other digital assets. You could even see this one merge with a more traditional bank for that complete digital wallet idea. Now, since the company just issued shares and hasn't been around that long, we don't have much financials here, but 364% sales growth over the last year is outstanding. And that's probably going to moderate here in the first half of the year because crypto hasn't been doing quite as well. But like Zoom, we could see that growth ramp up again as the company expands into these other assets. Besides that strong sales growth, Coinbase is just now coming into its profitability and already booking a 42% net margin, making this one a cash machine. The sales are expected flat this year and 11% higher next, but I don't think Wall Street really knows how to analyze this one. And this sales growth is all dependent on enthusiasm for crypto, so there's really no way of modeling that, but when we start to see the company expand into more of those reliable and consistent services, you're going to see that forecast move up. And likewise with the earnings forecast, the street just really doesn't know how to model profits when the environment for crypto is so uncertain, so I wouldn't put too much faith in these numbers. What is really interesting here, though, is despite all that uncertainty and the weakness around sales and profits, analysts still rate Coinbase a strong buy with a $400 price target, more than 75% higher than the current price. The range is quite a bit wider here, so as low as $160 to the low estimate, but all the way up to $600 a share as well. Now, you saw from our growth stock screener that we still had 79 companies, which is way too many to research, so I want to show you how to narrow this list further, down to maybe 10 or 15 that you can research for which stocks to buy. And like you saw earlier, the first thing you can do is just tweak that screener a little bit to narrow your list, whether it's increasing the sales growth or adding other criteria. Now, you don't want to narrow this too much because you also don't want to miss out on any great stocks that might fall just under your factors. Now, the focus of our list is those growth stocks with positive margins, those already making money, but we can take this one step further and looking for companies improving that profit margin. Now, this means either through your screener or just through research, looking for those stocks with increasing profit margins over the last year compared to the previous year. Now, let me tell you why this is an excellent signal of a great company. It's hard enough to grow your sales by 20 or 30% a year. That usually takes an immense amount of marketing and other expenses. So most companies growing that fast aren't profitable or surely aren't getting more profitable. But if you can find a company that is growing its sales by that rate and becoming more profitable, so continuing to grow the sales but also cutting expenses, that's not only a growth stock, but one also with great management. And finally here, all you out there in the Bowtie Nation know I love me a good balance sheet. Now, this is the financial statement showing all the assets a company owns and the debt it owes. And what you're looking for here is a lot of cash and low long-term debt, preferably more cash than debt. NVIDIA, ticker NVDA, is one stock that continuously surprises investors with its growth. And while other semiconductor companies like AMD and Intel are going to face that weakening CPU market, NVIDIA has turned itself into a next-generation chip company with a decade of growth ahead in everything from Internet of Things to AI and self-driving. And for a company that's been around since 1993, the growth it's been able to post is amazing. Sales are up 45% in the last year and 27% annually over the last 3 years. And you would think that's reached its limit on profitability with that long in the market, but it continues to improve its margins from 26% last year to over 33% in the last 12 months. Revenue is expected higher by 26% over the next year to over $30 billion and just to keep growing from there. Sales could reach $45 billion by 2025, and I think even that underestimates the potential if NVIDIA is allowed to complete its merger with ARM. Analysts expect earnings to grow at an even faster 29% rate over the next year, so becoming even more profitable, and management has a great track record of beating those expectations. What's even more impressive, though, here is the forecast for earnings of $9.50 a share by 2025, double the profits expected this year. Their shares have already run aggressively higher, and analysts see it just 28% higher to the average target price. But if this one gets anywhere near that $9 a share profit estimate over the next few years, this is going to continue to run. Click on the video to the right for the 7 highest return investments for 2022. 7 investments ranked by risk and return that will make you money. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.